Thanks for tuning into Profit Insights. I'm your host, Neeraj Shah. It's an absolute delight to speak to Manish Chokhani. He needs no introduction. And over the next 23, 24 odd minutes, I'll try and sift through some of the key facets of the markets, the macro, both global and local, try and talk about market cycles because he looks at them with an eye that a few others do. Of course, we'll squeeze in the valuation question and how relevant that would be in the current context related to the past and some more. Manish, great having you. Thanks for taking the time out.
Thanks for having me, Neeraj.
The pleasure is... Yeah, been very long. So the pleasure is entirely mine. Manish, I would love to understand how you look at the global and local macro, if I can kickstart that conversation, because it seems that it's impacted as it is by a variety of factors at every single point of time. Just that the spate of the overhang of geopolitics on global macro now seems to be an unending one.
Yes, Neeraj, your question is absolutely right. It is something that's been playing out for a few years now, that the regime change in the world from the very West-dominated, kind of architecture which was made is changing. And in that period, it's very normal to see these kind of tumultuous events because it's like a kind of a power fight going on between the two ends of the world, with the US and its allies on one side and Russia, China, Saudi, Iran, and the others on the other side. And therefore, this architecture, until it's kind of reframed, I think we're going to just see more of the same. And one should actually be a little more defensive in the context of what to expect from the world, rather than assume everything is going to be as it was in the what I call the golden era of capitalism, which lasted all the way from breaking of Berlin Wall in 1989, pretty much till 2020.
Okay, so Manish, how do you think about this? Because it's almost impossible to predict how long can such a change, if you will, or the process of change really last, and because India has shown its hand to be a neutral body in this, how does an Indian investor, whether investing in India or like you probably investing in India and overseas as well, approach something like this? What's the thought process?
No, look, the Indian macro and the Indian positioning in the geopolitical world has never been any better. And that's playing out very well. I think the regime did remarkably well when this Russia crisis broke out to stand our ground and say that, we can't afford to get ourselves knocked out by having spiraling oil prices. The way the last time we got stuck when they put sanctions on Iran and we complied and China did not. And China benefited from that. So I think that learning has been great. I also think it's time where we will have to grow up and act a bit more like, we're already the fourth largest economy. We're going to be the third largest economy, but we are still kind of trapped in some paradigms of the past, which even we will need to step up and change. As a small example, the RBI has already been trying to internationalize the currency. And small amounts of UPI payments are happening across, whether it's the Middle East or Singapore. I believe they were also trying it out in France during the Olympics and so on. But the crux of the matter is that we are holding $675 billion of reserves, which is more than 15%, 16% of our GDP. And to have that kind of money locked up, really not making us returns other than that 1-2 lakh rupee dividend which goes to the government, is a travesty. And we also complain about liquidity being tight in India, and this kind of slippage going out to international markets from India is just not on, given the acceleration in growth that we need. So some of these changes as they occur, I think it sets the stage for faster growth in India. Depends how and when they play this out, but it's something which is inevitable. The rupee is going to be a lot stronger than people have been used to in the last 20 years. I think rates in India should be significantly lower compared to what they have been in the past. If one looks across the world and just removes the labels from the US and UK, for example, they're running 5% type fiscal deficits. They're running 3% upwards current account deficits. And there's no way these currencies are going to stay as strong as they are. And if we don't act, we're going to end up importing inflation because it's going to come to us via imported commodity prices. And there is going to be an upsurge also in hard assets, precious metals like gold, silver, uranium, and so on. So that's really the backdrop in which one has to operate in this kind of market environment. While at one level we are very sanguine about India will continue growing at whatever it's 7% type GDP, our valuations are not now leaving a lot of room for comfort, despite all the rosy, clear blue skies that seem to be ahead of us. And I'll just paraphrase what Warren Buffett used to say, that you pay a very, very high price for a cheery consensus. And currently, we do have that cheery consensus around India. Let me just pause on that.
Okay. Any chance that this cheery consensus could play out differently than how it has in the past, Manish, simply because the one factor that is notably different, and I know it's foolhardy usually to say that this time it's different, but the one factor that is different since maybe the COVID lows is the consistent, recurring and increasing domestic flow, which is forming, which is helping the markets form a base much quicker than what has happened in the past.
No, it's true, Neeraj. What you say, these flows have been incessant. And in fact, if you had asked me this last year, I would have said this market is going to just go into an explosive bubble on the way up. And the melt up has surely been occurring on the small cap, mid cap side. One has also seen some craziness going on the FNO side of the market. We're already at 150% of GDP in terms of market cap, which is really the peak we hit in 2007. So all from those parameters, it's a bit giddy to be sitting where we are. The only happy note over here is that the large caps don't look excessively mispriced. We may be 6 months, a year ahead in terms of earnings, but let's say this market were 10-15% lower, everyone would be fairly comfortable saying let's come back and buy it again. And to be honest, most of the foreign investors have been waiting for that sort of pullback in the market without much success to come back in. So my best guess is if this market just stays where we are and we just tread water for some more time and we arrive into the next year at similar sort of valuations, I think everyone will be feeling a lot more comfortable. If, however, we do some of these policy things which were expected of India, such as on the foreign exchange front, such as on labor reform, such as on agricultural reform, and so on, and start getting this economic engine running a lot faster with lower inflation, then the deluge of money which is going to come to India from overseas cannot even be quantified. And then you have the classic makings of real acceleration, because you have domestic money continuing to come in through these SIPs and so on, plus, of course, the money which is coming through the EPFO and the LIC and so on, and it'll be supplemented by the foreign money. So until that happens, I would think the best course for us is really to tread water, and hopefully some of the supply response, which the corporate sector is doing by selling paper down into the market through primary issuances or QIPs, that hopefully just keeps a lid for some time to allow us to really grow earnings into these valuations, because we are ahead of what reality is currently.
Got it. And you reckon that the flows globally, or as the case may be, would be amongst many other factors also seeking the regulatory changes and the reforms that you alluded to, because some of these have been tried, half successful, given up, etc. It's a new term, 5 more years. You reckon the chance is the best to do it in the next 12 months?
No, Neeraj, like I said, it's a valuation thing that, at a certain price, you're pricing in a lot of perfect execution.
Got it.
If let's say this price was 15% lower, you would have seen a lot of flows coming in. Given where the prices are and given the slightly weakened mandate, the expectation that you can ram through things, which, for example, on the labor reform side or even on land reform side, on skilling and getting a lot of jobs getting created a lot faster, which will require ease of doing business, judicial reforms, and so on. So some of that certainly has become a little more tepid in I think the overseas investors' mind. Having said that, I mean, give this market some time to correct on valuation, either time-wise or value-wise, and you'll certainly be surprised by the amount of strong foreign inflows that are waiting to come in.
Okay. Just one more question on this whole market, actually two more questions before we take that break, Manish. One is the last 18 odd months, some bit of global scrutiny that Indian markets have gone through. I mean, but just the difference that the market showed in shrugging off let's say, for example, I'm just using that as an example, the Hindenburg note that came in over the weekend versus what happened in the past. And the fact that Indian markets now seem to be a lot less high beta than what they were. I mean, traditionally we've seen global markets correct 5%, Indian markets would correct 10. We are looking very different now. I mean, are there some signs that you read from all of this that is happening, what happened yesterday and today, or what happens in the last few months when the global market correction has happened and India has not corrected as much?
Neeraj, this is really, like I said, if your country has gone from whatever rank 50 to rank number 4, it's a sign of becoming a lot more confident about yourself. In the past, any foreigner wrote anything about us, leave alone Hindenburg. I mean, he's like just a small kind of brokerage trying to short sell. Really not relevant. Otherwise, I remember in the past we would get so freaked out if either the Economist or the New York Times wrote a bad article about India, and everyone would be, going around like, "Oh my God, see how the foreigners are viewing us." You don't care. These guys, I mean, beyond the point, most people tend to write leftist kind of stuff in the popular media. So I don't think it's like how in IPL, the advent of IPL stopped us from worrying about what the UK and the Australian commentators are writing about Indian batting and bowling, right? So it's become a bit like that it's a country which is now comfortable with itself, with the trajectory we've set on growth for ourselves. Uh, you know, in this specific case, our regulators very, very admired, and they've done a fantastic job. So I think the market clearly just saw this as some broker somewhere trying to write an article and profit from it. And one shouldn't put too much credence into whether it's the mainstream media or articles like this. This country is on a march of its own and it's going to arrive at its destination, but whether we like it or not, whether those guys like it or not. And it's in the same way that the rating agencies are behind the curve. That if you continue to treat India as triple B plus when UK is running a 5% fiscal deficit and a 3% current account deficit, and they get a high rating, it's showing you that the markets have given you a sign that the Indians are going and supporting the British economy by buying, Land Rover or by, as Sunil Mittal has done today. Well, their markets are bombed out and they need support of foreign institutional inflows. And in fact, to support their country rather than us. You saw the reception Chandra got when he had to go in and do a small project in the UK, and the Prime Minister turned up for that. It's just showing you the rising importance of India.
Yeah.
And I think in our mind we should forget about all these minor criticisms that will inevitably appear in our way from people overseas.
Yeah.
And let me just leave it at that.
Yeah, no, maybe it makes the market healthy. Just one follow-up, Manish, to an earlier answer that you gave. I heard you say that, Neeraj, if you had asked me this 12 months ago, I would have told you that we are on track to be the ultimate bubble market. Are you trying to say, therefore, that things have changed between then and now, which make you feel that we may not be the big bubble market of the current decade?
Yeah, first of all, I always hoped we would not be, because the problem with bubbles is when they burst, they're very, very painful.
Right.
It's exciting on the way up. But like you saw, when the Japanese and the Taiwanese bubble occurred in the late 80s, it took them almost 40 years to come back from there. Same way when the Nasdaq bubble burst in 99, 2000, period, it took the Nasdaq 15 years to come back to the same level. While we are currently celebrating tech, the period in between was very painful. Even when we guys went through the so-called BRICS bubble, which culminated in 2007, remember, other than India, emerging market indices have not yet crossed the 2007 high. So bubbles are exciting when you're participating, but then you've got to live the next 15 or 20 years on the money you made during the bubble or not. So in that context, I'm happy that it hasn't occurred. Some of it is, of course, due to our regulatory steps, but it's also, like I said, due to this, A, valuation fears, and B, the fact is that some things have certainly not gone India's way in terms of say a super majority coming through in parliament where you could be a lot more speedier on your reform process, for example, or a lot bolder on the steps we would want to take in terms of getting the economy to accelerate. And certainly on the foreign exchange side, where, country which is fourth largest in the world needs to be now putting in place swap arrangements with its trading partners and its so-called allies rather than saying, let me sit on a bank balance of $675 billion. So some of these things are going to change inevitably over the next few years. And hopefully we then grow into the kind of earning trajectory which we seem to have settled into, which is, by the way, it's not that great. If I look back, the mid cap indices from a 2018 pre-COVID level are what, two and a half times. It's because they had collapsed during COVID that it looks like we're up 6x from there. But on an aggregate basis, we haven't really done anything much.
Yeah.
So again, let me just pause and let you continue.
Just so one follow up there, Manish, because I'm trying to think of and some of the stuff that you had shared with me as well. When I look at compare this to what's happened globally as well, in a lot of very high profile, more sought after businesses or stocks, as the case may be. I mean, Nvidia adding in 10 days what Berkshire Hathaway took generations or decades to do, or Apple and the multiples that have happened and gone up the way they were, or such a concentrated move in the US markets, right? Whereas India's probably broadened out a little bit. How do you think of the dichotomy of what's happening elsewhere versus what's happening in India? And does that tell you anything?
It does. And in fact, the greatest investor in the world is sitting on $275 billion of cash. So if Warren Buffett sees there is trouble in valuations in US and he's in cash his Apple stock, it certainly tells you something. Also, this hype around AI that currently it's really a productivity tool. And if you put 600 or $700 billion into AI, for sure it'll be something which will be of great value in the years ahead. But to produce an ROI on that in the short run and to also support this kind of valuations to keep growing at that pace, it's setting up for a gigantic climax in the US. So it's a bit like 2007 market, where in that era, of course, we came off the post 9/11 lows, and then our market actually just rallied very, very furiously. And if you recall, it's those very stocks which were the darlings of 2003 to 2007 bull market, which then did not perform for the next 15 years, which came back and started leading this market. And they were what? They were PSU shares, they were the industrials, L&T and the like, they were all the commodity shares, and of course the fourth one, which are banks, which so far haven't performed at all. But if that category then went to sleep, the current bull market got led again back by PSUs, then the industrials, and then of course commodities started lifting off, and we are being priced a lot higher than most commodities elsewhere in the world. Whereas US is still seemingly in the 2001 era of tech, by extending their money printing presses and their fiscal deficits. They've kind of extended their bull market in tech, which should have by now faded. And the world normally in cycle theory would have been back to the era of a little more hard assets and the value kind of stocks, which is what you're kind of seeing in the broad basing of the Indian market, and also the US rotation to the small value kind of companies has actually already started. While everyone's focusing on the climax happening in Nvidia and the others, that move is also actually already underway in the rest of the world.
Manish, just the fact that the diversity of the Indian market has increased so exponentially. One sell-side brokerage was telling me that they have 67 sectors now, or 67 wow. themes that they look at. I'm trying to understand, how do you think about this versus the past, maybe?
It's a great question, Neeraj. Actually, I think the terminal value and longevity of India has certainly gone up in my mind and everybody else's mind. We were always a great country with a great destiny, but we took a number of correct steps, and the demographic dividend coming together, plus the way the world has shaped up, has put us in a sweet spot, which, I mean, really you haven't seen for the last 30 or 40 years. So the premise that the growth is a lot more stable and a lot more durable and a lot more longer lasting is absolutely correct. And that's also the reason the market's so excited about what lies ahead of India. That if we are indeed at a 4 trillion kind of GDP today, will we not be 20, 25 trillion over the next couple of decades? It looks like a realistic goal. In that context, if you sit back and think that if you build a good position in a good company, and I'll just use the Rakesh Jhunjhunwala example, that if he bought his whatever 6 and 8% stake in Titan and he just sat on it for a number of years, it went through periods when it was very, very excessively valued, and then it's fallen back. It may still be at, I think it's currently 70 times earnings current year. But if the company continues to grow into this 5x growth of India over the next 20 years, you still create a lot of wealth there. And to put in context, if I look at, say, the 100th market cap company of India today, if I'm not wrong, it's probably Polycab at a 1 lakh crore market cap. The promoter holding is 65%, which is still more than India's richest investor made through his investing career. So if you sit even on a mid cap type company which has longevity for the next 20 years, and you're comfortable with that company and the capital allocation is fine, I think you'll do all right. The flip side though is that most investors who are coming in today to the market are expecting to make money every day, and they haven't seen a drawdown. So it's not about which sector or which company or which country. It's about your own level of conviction and knowing of the company, and your preparation to be like a durable investor in that. If you're going to buy something today, for example, let's say a lot of these new age companies which have come out, which are indeed on an explosive path, whether it's Zomato or Nykaa or FirstCry, which listed today, or even Ola Electric, they're all on a trajectory. But when you are buying someone at 10 times the cost at which they put it up, or 10 times of their holding value, your horizon of holding that stock has to therefore be that much longer. And if you're not going to hold these stocks for the next time we get so kind of buoyant about India and its economy, the next euphoria cycle, if I can call it that, which may be 10 years away, then in the interim you may have damaging returns on your portfolio. So that's the only distinction I'd like to make. Otherwise, honestly, in India we are in such a sweet period in our history that any sector that you pick and a company that you pick, if it's around over the next 15 or 20 years, is going to create wealth for you. So let me just hold that thought and continue with your questions.
Such a nice way to put this out, Manish. Thank you for laying it out so beautifully. Um, uh, so let's assume all cylinders firing. Hopefully, they continue to do that. Is there something that's caught your eye particularly? It could be about the macro. It could be about what business commentary you're hearing from new age companies or old companies, because suddenly the banks and the metals have gone completely out of favor when it even comes to conversations. Or it could be about this whole conversations around jobs and what's happening thereof. We have time for one more question, so I'd love to not ask you what I want to ask you, but try to understand from you what has stood out for you across macro, commentary, micro, what have you.
No, I'll give you, like, for many years now, I've been playing on the assumption that there are 4 or 5 dominant themes which will define India over the next 20 years. The first one was financialization, and we are seeing that playing out. Now, it may be banks are taking a pause for now because this time the leadership really went to the corporate banks and the PSU banks, and not the so-called higher quality banks of the past, which were HDFC and Kotak. But their time will come too. So financialization was one theme which one, then fortunately played through the exchanges or wealth managers, asset management companies, and so on. And there's enough room over there because this theme of financialization is very, 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 very large. And I'm actually happy that sometimes when the banks don't perform, it allows you to nurture your position for longer, even though they're going to keep compounding at, let's say, 15%. If they do 15% for 10 years, one is quite happy with that. The second big theme was, of course, privatization plays, because as the government withdraws from the economy, you will get people. So whether it was the ports or the airports or the telecom players or the airlines, they start creating wealth because these are, in a sense, they become natural monopolies or oligopolies. And these businesses have long lasting trajectories, which incumbents can't easily get shaken out of. So that was kind of area two. Area three was, as we get richer, which we are, it's going to be about discretionary expenditure. So whether you're going to travel a lot more, whether you're going to eat out a lot more, whether you're going to buy better cars, better durables, whether you're going to do home improvement. So there are a lot of thematics which come around from consumer discretionary, which is theme three. And theme four is, as you digitize the economy, all these platform plays of the like I spoke about will become powerful. And while currently we are very excited about manufacturing themes, I particularly, have holdings in renewable area, in sustainability, recycling, and stuff like that, because it's the thesis that what's good for the world is going to be good for business. And if there are not too many competitors around there, and you have scale, you can become a very, very large player over there. So those become 5 dominant things. What I look for now, honestly, is someone like this Ola. And again, I'm not recommending this company, nor have I invested in it. But India needs to now go from being a processor for other people, like our IT services were or our generic pharma were, to becoming a product nation, where we should own the underlying technology, we should own the underlying brand, and we should be then becoming global from here. And my sort of pet thing today to look out for is that if China is so ahead of us on whether it's AI or robotics or biotech, we should not miss this like we missed the Industrial Revolution and they kind of go backwards in the hierarchy of nations. And we need more and more people like this to come out who build the whole tech stack and who own the entire value chain. And then you can decide where you want to play. So again, like I said, it's not about Ola in specific, when the valuation is certainly something which is very far ahead of reality. But someone like that at an opportune time, if God willing, there's a crisis in the world, I don't wish anything bad for anyone and the current holders, but our job as an investor is to take asymmetrical bets when the odds are in our favor. Currently, everyone is on the same bet on the same time. So when you say that banking is hated right now, it gets my ears to open a lot more, because then that's the place to look at. Like we were buying PSUs 5 years ago, and PSU banks were being thrown away and discarded. Whatever is hated eventually comes back because markets have a tendency to revert to mean. So when you go too far away from the mean, you will revert back. So some of our stocks have gone too far in excess of reality, and certainly on the engineering and capital goods and PSU and consumer discretionary kind of side of the market, 60, 70, 80 multiples. Because look, long term, for a company to make somewhere between 15 to 25% return on equity is a big deal. And if you're paying 2 times, 3 times, 4 times of that, uh, I can't imagine how many more years of longevity and high growth do you need to see for you to grow into those earnings. So I tend to be a little more value investor type. While I believe in the growth of our country, and I think we do have fabulous years ahead of us, but really value is what you pay, and that's really what you should be hoping for, to be a kind of an M&A specialist. That would you buy the entire company at this price? That's all I can submit.
And that's all that is needed, Manish. Such a fantastic conversation. Thank you. And what stood out for me, like both the things, Manish Chokhani is expressing optimism when he's talking about how Indians are going abroad and being the FIIs for some of the countries. And at the same time,
Right.
yeah, sorry, Manish.
No, absolutely. I mean, it's not just about Bharti and others buying it. The Indian investors need to prepare, because we will be investing outside in a big way in the next 5 years.
Yeah.
The rupee will be a strong, stable currency. It will be an international currency. And we can't be frogs in the well only looking at our market. And therefore, this tinderbox over here will also have to open. And people will be buying stocks in China and they'll be buying stocks in UK and in US. And that will change the geopolitics in our favor, because eventually money talks.
Yeah, eventually does money talk. But at the same time, some words of caution as well about some things that we need to do. Manish Chokhani, I don't know why we take so long. I agree your time is precious, but I'd love it for you to share some more time with us in a calendar, because this was just fabulous. Thank you for talking to us today.
Thank you so much, Manish. Thank you.
And viewers, thanks for tuning into this very insightful episode of Profit Insights.